Traders can experience losses in the market for a variety of reasons. Some common reasons include lack of knowledge and experience. Trading in the markets requires a certain level of knowledge and experience. Traders who lack these qualities may not fully understand the risks involved in trading and may make mistakes that lead to losses. Emotions. Trading can be an emotional experience, and traders who let their emotions guide their decisions may make irrational choices that result in losses. Fear, greed, and hope can all cloud a trader's judgment and lead to poor decision making. Market conditions. The markets can be unpredictable, and traders may experience losses due to sudden changes in market conditions that they did not anticipate. Poor risk management. Traders who do not have a solid risk management plan in place may take on too much risk, leading to losses that are larger than they can afford. Trading on leverage. Leverage can magnify both gains and losses, and traders who use too much leverage may experience significant losses if their trades do not go as expected. Poor timing. Traders who enter and exit the market at the wrong times may experience losses due to market volatility or missed opportunities. Overall, trading in the markets can be a challenging and risky endeavor, and traders who are not properly prepared may experience losses. It is important for traders to have a solid understanding of the markets, a good trading plan, and effective risk management strategies to minimize the risk of losses. How to overcome losses in market? Experiencing losses in the market is a normal part of trading, and it is important for traders to learn how to overcome losses and move forward. Here are some steps that traders can take to help overcome losses in the market. Review and analyze the trades. Traders should review their trades and analyze what went wrong, including the reasons for the losses, the entry and exit points, and any mistakes that were made. This will help them learn from their mistakes and avoid making the same errors in the future. Develop a new trading plan. After analyzing their trades, traders should develop a new trading plan that incorporates the lessons they learned from their losses. This plan should include a solid risk management strategy and realistic expectations for profits. Manage emotions. Emotions can be a major obstacle to successful trading, and it is important for traders to manage their emotions and maintain a level head when trading. Traders should avoid making impulsive decisions based on fear, greed, or hope and should instead stick to their trading plan. Learn from successful traders. Traders can learn a lot from successful traders who have a proven track record of success. They can read books, watch videos, and attend seminars to gain insights into the strategies and mindset of successful traders. Keep learning and practicing. The markets are constantly evolving, and traders need to keep learning and practicing to stay ahead of the curve. Traders should continue to educate themselves about the markets, try out new trading strategies, and practice in a demo account before trading with real money. Overall, overcoming losses in the market requires discipline, patience, and a willingness to learn from mistakes. Traders who take the time to review their trades, develop a solid trading plan, manage their emotions, learn from successful traders, and keep learning and practicing will be better equipped to overcome losses and achieve long-term success in the markets.